On Tuesday, SEBI released a consultation paper packed with proposed changes aimed at strengthening the index derivatives framework. Now, before getting into the details of the report, let's first understand what are derivatives. Derivatives are financial contracts whose value is based on an underlying asset. There are two main types of derivatives: futures and options contracts. They enhance price discovery, boost market liquidity, and provide investors with tools to manage their risk even more effectively. Now, why is SEBI worried over rising trade volumes in the derivative segment? After the 2020 pandemic, weekly options gained popularity among both retail and proprietary traders. In the report, the SEBI highlighted that weekly index derivatives became particularly favored around their expiry dates. This was evident from the heightened volatility and trading activity observed on expiry days compared to other trading days. Index option volumes on NSE, which holds over 90% of the market share, increased to nearly 13-fold to rupees 138 trillion in fiscal year 24, up from rupees 10.8 trillion in fiscal year 20. This surge in trading volume has drawn increased attention from SEBI. As per Business Today, these regulations will lead to a plunge in market volumes by up to 40%. Now let's understand what exactly SEBI is proposing, how it could shake things up for F&O traders, and why these steps are essential given the recent surge in retail participation in the Indian stock market. SEBI has proposed 7 key changes in the report, but we will focus on only those points that will have the most impact on the retail investors. The first one is rationalization of strike price for options. When exchanges introduce options contracts for indices like Nifty and Bank Nifty, they set a range of strike prices, that is, the price at which the option can be exercised, around the current index value. However, the current practice has some issues such as scattered liquidity and artificial trades. SEBI has proposed that the strike interval should be uniform around the prevailing index price, with the interval increasing as the strikes move further away from the prevailing price. Additionally, no more than 50 strikes should be introduced for an index derivatives contract at the time of contract launch. New strikes should be introduced daily to comply with the above mentioned requirements, and exchanges should uniformly implement and operationalize these principles after joint discussions. Now coming to the second change, upfront collection of options premium. The current practice for futures positions require that when you buy or sell futures, whether taking long or short positions, you need to pay an upfront margin. This margin acts as a security deposit to cover potential losses. For options positions, an upfront margin is required when selling options. However, for buying options, buyers only need to pay the options premium, which is the cost to purchase the option, and this premium is not always collected upfront by brokers. This practice presents several issues. First, option price can change quickly and dramatically. Second, without upfront premium collection, buyers might take on positions they can't afford, leading to potential market instability. There are collateral issues as well. To address these issues, SEBI has proposed that brokers must collect the options premium upfront from buyers to ensure they have sufficient funds to cover their positions. Next is rationalization of weekly index products. Stock exchanges currently offer weekly expiry index derivative contracts in addition to monthly contracts, resulting in expiries on all 5 trading days of the week. This practice encourages high speculation and volatility, as expiry day trading is predominantly speculative, leading to increased market volatility, particularly during closing times. Such speculative activity often results in poor profitability for individual investors. To address these issues, it is proposed to limit the offering of weekly options contracts to only a single benchmark index per exchange. And last, increase in margin near contract expiry. The current margin requirements do not account for the increased trading activity and volatility that occur around expiry, as these margins remain unchanged despite the heightened risk. As options premium decrease near expiry, the notional risk increases and the existing margin requirements fail to adequately cover this higher risk, leading to potential vulnerabilities in the market. To address this issue, it is proposed to increase margins near expiry. Specifically, the extreme loss margin should be increased by 3% at the start of the day before expiry and further increased to 5% at the start of the expiry day. Now, who will be most impacted due to these changes? SEBI's proposals are expected to significantly impact the brokerage industry, especially those heavily reliant on retail clients. Brokers like Angel One, 5 Paisa Capital, and others are likely to be hit hardest due to a potential decline in trading volumes. After the release of the report, these stocks also plunged by up to 5%. Full-service brokers with a diversified client base might be less impacted but could still see a decline in options-related revenues. Reduced trading volumes could impact exchange revenues. However, the BSE might benefit from a potential shift in trading activity from other exchanges. And also, share price of exchange operator BSE rose 7.5% today. Reduced options contracts and higher minimum contract sizes could limit trading opportunities for small investors, and increased margins might impact their trading capital. In short, SEBI's proposed measures are about creating a safer, more stable market for everyone involved. With the rise in retail participation, these changes are timely and necessary to ensure that the Indian stock market remains a robust and reliable place for all investors. So whether you are a seasoned trader or just keeping an eye on the market, these changes are worth paying attention to. Having said that, this is Aditi Priya signing off.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.